The market opens. Your phone buzzes, down 3% already. Your stomach tightens. You refresh the page, down 4%. The news headlines scream crisis. Analysts who were bullish yesterday are predicting a collapse today. Your portfolio, carefully built over years, is evaporating before your eyes. This is 2026, and market volatility has become the only constant. Economic uncertainty, geopolitical tensions, technological disruption, regulatory changes, all converging to create price swings that would have been unthinkable a decade ago. Most investors respond to this chaos with panic, desperation, and reactive decisions that destroy wealth faster than any crash ever could. But there is another way. Marcus Aurelius ruled the Roman Empire during plague, war, and constant upheaval. He faced volatility that makes modern markets look tame. Yet he maintained absolute composure through a simple philosophy. You cannot control what happens, only how you respond. This is Stoic investing, not predicting the future but preparing your mind, not controlling the market but controlling yourself. The financial landscape of 2026 is unprecedented in its complexity and speed. Technology has accelerated everything to a pace human psychology was never designed to handle. Cryptocurrency swings 20% in a single day on a single tweet. Stock markets react to social media sentiment in minutes rather than absorbing information over days. Artificial intelligence algorithms make millions of trades per second, creating volatility patterns that seem random to human observers. Retail investors have tools that rival institutional capabilities, access to real-time data, commission-free trading, option strategies, leveraged products. But they lack the emotional discipline to use these tools wisely. The democratization of investing has created democratized panic. When markets fall, millions of retail investors sell simultaneously, creating cascades that feed on themselves. When markets rise, fear of missing out drives buying frenzies that inflate bubbles beyond any rational valuation. This is not efficient price discovery. This is collective psychology amplified by technology. And if you participate in this emotional contagion, you will be destroyed by it. Consider Daniel, a 38-year-old investor navigating 2026 with $250,000 invested across various assets. He works in tech, understands markets reasonably well, reads financial news regularly, and believes he is a disciplined long-term investor. But the volatility of this year has tested him like never before. His portfolio has experienced 5 separate drawdowns of 15% or more. Each time, he has felt the overwhelming urge to sell everything and move to cash. Each time, he has fought the urge and held his positions. Each time, the market recovered eventually. But the psychological toll is crushing him. He checks prices dozens of times per day. He reads every market analysis he can find. He watches financial shows constantly. He joins forums where people debate whether this is the top or just a correction. He is consumed by anxiety about the next crash, the next rally, the next policy change. This is not investing. This is suffering. Marcus Aurelius would recognize Daniel's problem immediately. He is trying to control what he cannot control, and that futile effort is destroying his peace of mind. The first principle of Stoic investing is radical acceptance of volatility. You cannot make markets stable. You cannot eliminate uncertainty. Volatility is not an aberration. It is the permanent condition of markets, especially in an era of technological acceleration and global interconnection. If you cannot accept wild price swings, you fundamentally should not invest in volatile assets. Period. Marcus wrote in his private journal, "The universe is changing. Life is an opinion. Markets change constantly, sometimes violently. The only question is your opinion of that change. Daniel views volatility as a threat, an enemy to be feared and avoided. This view creates constant suffering because the thing he fears is omnipresent. The Stoic views volatility as neutral, neither inherently good nor bad, simply reality. A feature of the system, not a bug. This view creates equanimity, because reality is being accepted rather than resisted. Daniel's transformation began when he stopped fighting volatility and started accepting it as the permanent condition of his investment environment. He wrote a statement and posted it where he would see it daily. I am invested in volatile assets. Large price swings are normal and expected. I will experience multiple significant drawdowns every year. This is not exceptional. This is the nature of what I have chosen. He read this statement every morning before checking any prices. At first, it felt like lying to himself or lowering his standards. But over weeks of repetition, something shifted in his psychology. When a drawdown came, instead of panic and surprise, he felt recognition and acceptance. Here is the volatility I was expecting. This is normal. This simple cognitive reframe reduced his anxiety by roughly half. He was no longer being surprised and threatened by volatility. He was experiencing what he had already accepted as inevitable and built into his mental model. Second principle, distinguish price from value relentlessly. In 2026, price movements are often completely disconnected from underlying business value. Algorithmic trading based on technical patterns rather than fundamentals. Sentiment-driven flows from social media. Leverage amplifying small moves into large ones. All create price action that has nothing to do with whether businesses are actually becoming more or less valuable. Daniel owned shares in solid companies with growing revenues, strong competitive positions, excellent management teams, and sustainable business models. When the market crashed in March and took his holdings down 25% in 2 weeks, the companies themselves had not fundamentally changed. Their ability to generate profit, serve customers, and compound value over time was essentially the same as before the crash. Only the price, which is just what someone else is willing to pay right now based on their emotional state and circumstances, has changed. Marcus would say the price is an external event, completely outside your control, and therefore not something to base your peace of mind upon. The quality of the companies, their competitive advantages, their management integrity, these are things you can evaluate and understand, which gives you a foundation for decisions. The Stoic practice is to ignore short-term price movements entirely, unless they create opportunities based on your assessment of value. If you own a good company purchased at a fair price, and the price drops significantly for no fundamental reason, that is potentially an opportunity to buy more if you have available capital. It is absolutely not a reason to sell unless the fundamental thesis has changed. Daniel started asking one simple question during every period of volatility. Have the fundamentals of what I own actually changed? If the answer is no, the price movement is just noise to be ignored. If the answer is yes, then he needs to reassess his position. This single question cut through the emotional chaos and created clarity. He discovered that 90% of price movements required absolutely no action because they were noise completely disconnected from the value of the underlying businesses. Third principle, establish rules during calm and follow them mechanically during chaos. Most investors make decisions in the moment, when emotions are most intense and judgment is most impaired. This approach guarantees bad decisions. The Stoic establishes clear principles and rules during calm, rational periods when emotions are not clouding judgment. Then follows those principles mechanically during volatility, regardless of how it feels. Daniel created a simple one-page rule sheet after studying his past mistakes. I will invest a fixed amount monthly regardless of market conditions. I will rebalance my portfolio quarterly according to my target allocation, not more frequently. I will only sell a position if the fundamental thesis deteriorates, never because of price movement alone. I will check my portfolio value once per week maximum, on Sunday mornings. I will not make any investment decisions within 24 hours of significant market moves. I will not discuss my portfolio with people who are panicking. These rules removed discretion during the times when he was least equipped to use discretion wisely. When the market crashed and his emotional brain urged him to sell everything, he consulted his rules. They said hold unless fundamentals have changed. The fundamentals had not changed. Therefore, hold. He held, not because he felt confident or brave, but because he had committed in advance to following his rules regardless of how he felt in the moment. This is true discipline, not feeling courageous, but acting according to predetermined principles despite intense fear. Marcus ruled the empire through plague and war by following his Stoic philosophical principles even when circumstances made it incredibly difficult. Daniel invested through chaos by following his self-imposed rules, even when his emotions screamed to abandon them. Fourth principle, use volatility as a teacher, not enemy. Every period of market volatility reveals something valuable about your psychology, your assumptions, your actual risk tolerance versus your imagined risk tolerance. Where are your breaking points? What triggers your emotional reactions? What false beliefs are you holding? Daniel started keeping a detailed journal during volatile periods. When he felt panic rising, he would pause and write, "What exactly am I feeling right now? What am I afraid will happen? What am I assuming about the future? What evidence supports or contradicts these assumptions?" This practice created a crucial distance between the feeling and any potential action based on that feeling. He discovered patterns that were invisible when he was not paying attention. He panicked most intensely when he had checked prices multiple times in a single day, creating a feedback loop of anxiety. He felt most calm and confident when he had avoided financial news and social media for several days. He made his worst decisions when he was tired, stressed from work, or had been arguing with his wife. These insights were invaluable for adjusting his behavior. He deleted price-checking apps from his phone entirely. He blocked financial news websites during work hours. He established a rule that he would not review his portfolio or make any investment decisions when tired or emotionally stressed from other life areas. These simple behavioral changes, learned directly from paying careful attention during chaos, dramatically improved his emotional experience of investing. Marcus viewed every challenge as an opportunity to practice virtue and strengthen character. Daniel viewed every volatile period as an opportunity to learn about himself and strengthen his discipline and self-knowledge. Fifth principle, maintain perspective through the view from above. When you are immersed in daily or hourly market movements, everything feels urgent and monumentally important. Every swing seems to matter. Every news headline appears significant. Marcus used a technique he called the view from above, where he would imagine viewing his life and the empire from far above, as though from the stars. From that cosmic perspective, the daily dramas and politics of Rome were revealed as appropriately small and temporary. Daniel adopted this technique for investing. He would imagine viewing his entire investment journey from the end of his life, 40 or 50 years in the future. From that perspective, would the 25% drawdown of March 2026 matter at all? Obviously not, unless he had panicked and sold at the bottom. What would matter from that future vantage point is whether he maintained his discipline, whether he kept investing consistently through fear, whether he learned and adapted his approach over time. This perspective shift made daily volatility feel appropriately small and temporary rather than catastrophically important. He was not investing for next quarter or even next year. He was investing across decades. The crashes and rallies of any particular month or year were just noise in a much longer signal. This view did not eliminate the discomfort of watching his net worth decline during drawdowns, but it prevented him from treating temporary volatility as permanent catastrophe. When he felt panic rising, he would pause and ask himself, 40 years from now, looking back, will this particular moment matter? Will I remember this drawdown? Usually the answer was no, which allowed him to continue executing his long-term plan rather than reacting to short-term noise. Sixth principle: invest in your capability, not just your portfolio. Daniel realized through his Stoic studies that his true financial security was not just his net worth or portfolio value, but his ability to generate value in the world. He divided his focus and energy. Half went to managing his investments according to his rules. Half went to developing skills, knowledge, and capabilities that would remain valuable regardless of what happened in markets. He learned new technical skills relevant to his industry. He built genuine relationships with people in adjacent fields. He created multiple potential income streams beyond his primary job. He deliberately kept his expenses significantly below his income, so he would need less to maintain his lifestyle and have flexibility. These investments in human capital and capability created a foundation of security that no portfolio could match, because skills and capabilities cannot be destroyed by market crashes or economic downturns. Marcus focused intensely on developing his character, wisdom, justice, courage, and self-discipline, because he understood these were the only things that truly could not be taken by external events. Daniel focused on developing his skills, knowledge, relationships, and capabilities for the same fundamental reason. When markets crashed, his investment values declined temporarily, but his skills remained and even grew. This made him genuinely psychologically resilient because his security was not dependent solely on asset prices that he could not control. The Stoic investor builds both financial capital and human capital, recognizing that the second is ultimately more important and more permanent than the first. Seventh principle: practice premeditation of adversity. Seneca recommended regularly imagining worst-case scenarios, not to create anxiety, but to remove the power of fear through familiarity. Daniel adopted this practice for investing. Once per month, he would spend 30 minutes visualizing his portfolio dropping by 50%. How would that feel? What would he do? Could he handle it emotionally and financially? By repeatedly imagining and accepting this scenario, he built psychological antibodies. When actual drawdowns came, they felt less shocking because he had already processed the emotional impact in advance. The practice also revealed that even the worst-case scenario, while unpleasant, was survivable. This removed the catastrophic thinking that fuels panic selling. 1 year into systematically practicing Stoic investing principles, Daniel's external situation looks superficially similar to before. He has roughly the same amount invested. The market is still experiencing significant volatility. The news is still filled with alarming headlines. Economic uncertainty remains high, but his internal experience is completely transformed. He feels calm where he used to feel panic. He sees opportunity where he used to see only threats. He executes his plan consistently where he used to react emotionally. He sleeps well where he used to wake up anxious. The volatility has not decreased. The external environment is as chaotic as ever, but his response to volatility has fundamentally changed. This is the power of Stoicism applied to modern investing. You cannot control the chaos of 2026 markets, but you can absolutely control yourself within that chaos. And controlling yourself is the only control that actually matters. Marcus Aurelius never saw stock markets, never heard of cryptocurrency, never imagined algorithmic trading. But he understood deeply that external circumstances are always uncertain and often chaotic. Weather changes, enemies attack, plagues spread, allies betray. The solution is never controlling circumstances, which is impossible. The solution is developing internal stability that persists regardless of external circumstances. Daniel has developed this stability through consistent practice of Stoic principles. He has radically accepted volatility rather than fighting it. He has learned to distinguish price from value. He has established clear rules and followed them mechanically. He has used chaos as a teacher. He has maintained a cosmic perspective. He has invested in capability alongside financial assets. He has practiced imagining adversity. These practices have not made him rich overnight or eliminated all stress, but they have made him genuinely confident in his ability to handle whatever 2026 and beyond throws at him. The financial future remains radically uncertain. More volatility is absolutely guaranteed. Crashes will come. Bubbles will form and burst. Technologies will disrupt industries. Regulations will change. Geopolitical events will shock markets. But none of this uncertainty matters if you have built the philosophical foundation to remain calm, rational, and disciplined through all of it. The investors who thrive in 2026 and beyond will not be those who successfully predict the future, which is impossible. They will be those who prepare their minds to handle any future, which is entirely possible. They will be the Stoic investors who cannot be shaken by circumstances because their security is internal, built on character and capability, not external, dependent on price movements they cannot control. What is one Stoic principle you will implement this week to strengthen your investing discipline and reduce your reactivity to volatility? Share your answer in the comments. Subscribe to Money and Stoicism to continue developing the mental frameworks and practical strategies that create lasting financial success regardless of market conditions. Like this video if you are ready to face 2026 volatility and beyond with ancient wisdom rather than modern panic. Thank you for watching and for recognizing that true investment success is as much about philosophy and psychology as it is about finance and analysis. Continue your journey toward financial mastery and emotional resilience by exploring the principles and practices that integrate timeless Stoic wisdom with modern wealth-building strategies. Your transformation continues with each choice to prioritize discipline over emotion, principles over impulse, and long-term character development over short-term comfort. That path toward genuine financial freedom and peace of mind is available to you right now.